Welcome back to the show. Let's talk Tip TV education. Let's talk to Mr. Corvin Cordella. He owns CCFX. If you'll recall, if you watched before, he is a previous hedge fund owner and manager, and therefore he's been there, seen it, done it, as opposed to, dare I say, some of these people who are selling courses who haven't been there, seen it and done it. Corvin, very good morning to you.
Good morning.
Right, we've got 14 slides to go through. What's the subject today?
You wanted to know something about picking tops and bottoms on markets. So in essence, going against the trend, looking at turning points, also known as mean reversion.
Understood. Let's get, without further ado, I've got to hasten to add, before we see this, I've never seen somebody consistently pick tops and bottoms, so I'm fascinated by this subject.
Well, it's difficult, and I think there are two sides of the coin here. One's the secular turning points, we'll have a look at those very shortly, and one's sort of the much shorter term mean reversion side of things. But first of all, what do we mean by mean reversion? Well, there are three types of trading strategies. One's trend following, follow the explosive moves. The other one is looking for yield, just buying high yielding coupons, bonds that you get consistent income. And the other one is mean reversion, which is exactly what we're going to be looking at. And so if we go over to the next slide, in terms of turning points, as I said, there's the secular kind of turning point where you've had a trend for years and years, and everybody more and more in the news and on forums starts calling the short side of things, or the long side, and keeps on getting burned until it actually crashes. And then there's the mean reversion that comes naturally just because the market fluctuates. So if we look at these kinds of secular turning points in the equity markets on the next slide, it's pretty difficult to call them. And so what I've done here is actually I've also overimposed on the S&P 500 going back to 1950, this wonderful idea of the 18-year cycle, which actually works if you go even further back. And what you'll see is every 18 years, the market goes through a particular phase. We've had these bull phases in the 50s and 60s and the 80s, and these languishing side kind of points. But the reason I brought this up here is because you've got these wonderful turning points. 2000, everybody said 1998, 99, let's call it short, the NASDAQ will collapse, and never did. Everybody got burnt. Ultimately, it did go overboard. Similarly, since 2009, everybody said at some point the market has to crash. So if you think about it, we're actually now going into this wonderful 18-year cycle of a bull market, having come out of this previous languishing sideways thing. So as I keep on saying, S&P to 4,000, and we're just at the start of it. And it's absolutely wonderful. The S&P is now above 2,300. So calling turning points on this kind of scale is very difficult because it just is influenced by so many things. Next slide. It shows that you have the similar kind of stories in commodity markets, and this is actually very related to economic growth. 2001 was the bottom in copper, went all the way up to 2008 and all the way down. You see here again 2016, it looks like it's going to be a turning point to the upside if we believe in these secular changes and economic boom times coming about, especially in equity markets. But those are very difficult to call.
Yep.
So next slide. What we really now mean is look at mean reversion over the short term in terms of going away from the average. You see, mean reversion or calling turning points is like taking a rubber band, overextending it, and then feeling that force, pulling it back. So the natural thing, therefore, to look at a force pulling it back is to find this average. What's this average that exists to which you could be pulled back to? So if you go to the next slide, a very natural thing which we've just seen is the equity markets. You see that straight line up? So the natural trend in equities is up, and a very nice way to do that, if you actually looked at this previous slide, is there's a 200 daily moving average, which is the red line. Every time it's above the red line, we'll just call it an uptrend, the natural state of the market. So every time you have a down trend or a down thing in the market, it's natural to buy. So how do you define this downward movement? Well, it sounds quite abnormal or unnatural for the market to be down 3 times in a day. Especially if you're going up, you're in an up cycle, everybody's feeling optimistic, especially like now. 3 times in a row, it's pretty abnormal. So what happens if we actually buy every time the market is down 3 times in a row and we're above the 200 daily moving average?
That's 3 lower closes.
Exactly. Okay. So 1, 2, 3, then buy, especially when you're in an uptrend, yeah?
Yep.
Not in a downtrend, because we want to, be in line with the direction of the market. So let's go see what happens. So this is trading the SPY, Spider, the ETF, since 1993. As you can see, it's been consistently up. You've even managed to avoid the collapses of 2000 and 2008. So this is mean reversion in action. Very simple system. You can actually make it slightly more sophisticated rather than, because in this particular case, when you buy, you only hold it for a day. Maybe you want to hold it for slightly longer, see what the momentum is to the upside. But the concept here is you've determined an average. That's the natural state of the market, which is in this case upward movement. And you've seen that when you move away from the average, the market wants like a rubber band to come back up. And the equity markets, that force is so strong, you can make money consistently. And I'm telling you, just a bit more sophistication will make the line more smooth. And it'll actually work not just on the S&P, it works on the FTSE, on the DAX, on the CAC. So equities have this kind of force, and therefore the question is always look for that force, that bigger picture in the market, and then trade the mean reversion over much shorter time scales. So next slide, in FX, can you do that? Well, yes, because currencies are classified according to blocks. So we've got commodity blocks where we find naturally Aussie, CAD, Kiwi. So can we somehow look at doing something there, one versus the other, to create this kind of oscillating up and down, which we want to turn? So since Australia and New Zealand are very close geographically together, you could say, well, they're similar, speak the same language, some close to each other, same part of the world, both commodities. So let's see what happens if you have Aussie versus the Kiwi, which is sometimes quite a neglected kind of currency. And if you actually look at this chart, which is a monthly chart going back to 1998, this thing just goes sideways.
Yep.
It's constrained between 104 and 1.36, and all it does is go sideways. And it's got periods where it's, sideways. It has sort of shifts, which it had between 2000 and 2008, which was the big carry trade in Aussie. It also had the collapse between 2008 2010, which was the economic collapse. But all of it, it's more or less in that range. And you can see now Aussie Kiwi is at the bottom side of the range, so a natural kind of inclination would be to buy the upside at the moment in that currency. So again, we've postulated that because they're close to each other, the trend should be sideways. Look at the extension from a mean, and then buy or sell when you're close to that extension, which we are in this particular case. So sticking with Australia and actually Canada, also commodity block, you can do this with equities as well. There are these wonderful two ETFs, which are country ETFs by the MSCI, EWA and EWC. As you can see, as equities, they track each other quite closely because they're commodities. So you can actually divide one by the other in terms of price. And if you do that and you go to the next slide, you get the blue line. And that's the ratio. And as you see, the ratio is more or less constrained between 0.6, 0.8. And you can put some Bollinger Bands on this. And every time it goes above the green line, sell. And it goes to the lower Bollinger line, buy. And actually, if you construct a system on the back of that, it also is quite profitable. And I urge people to have a look and play around with this. So ultimately, mean reversion means find things which are closely related or which have an underlying story that drives the market in a particular direction. And every time you're away from that, well, trade back to the mean. And that's why mean reversion is very related to picking tops and bottoms are just when the market is way, way, way too far from what normality and actuality is.
Wonderful. I think we have one more slide.
So if you want more of these kinds of strategies, data, etc., then sign up on my website.
Corvin, thank you very much indeed for your time.